What is second to die life insurance or survivorship life insurance or dual life insurance? We're going to talk about that here today. It's one of my favorite topics to talk about for general estate planning, how to create an estate. And I just love second to die life insurance. Absolutely. I'm going to share with you why here today. So welcome to Heritage Wealth Planning YouTube channel, my friends, the place you come to learn about all things life insurance and all things financial planning, investments, retirement planning, Medicare, we're going to Social Security, obviously, budgeting, cash flow, the whole thing. You find it here at the Heritage Wealth Planning YouTube channel. So if you like what you see, hit that little red button down there to subscribe. And then once you do, don't forget to click on the bell to be notified. We do now over a video a day because it's just fun. I love it. And I got a lot to talk about here, as I've shared with many people before, my litany of books and just notes I've taken, all kinds of stuff. So come on board. The water is warm. All right. So second to die life insurance. So let me just tell you what it is. All right. So that way you understand. Then we'll go through an example here. Second to die, we got Charlotte and me. Now we have a policy. My wife and I do. We have it through the Knights of Columbus, and I'm not here to debate whether it's the best, but at this stage, don't care. But what happens is we are both the insured. So I'm a man, I'm 4 years older than my wife, so I'm going to die before she does. When that happens, the life insurance does not pay out, all right? It only pays out at her death. So we don't buy second to die life insurance to cover my surviving spouse because it's not going to pay out until she dies. That's a very, very clear distinction. I remember reading about this about 20 odd years ago, maybe 25 years ago, and the guy was writing in the Wall Street Journal, and I had no clue what he was writing about. He didn't explain it even then about how it pays out. It only pays out on the death of the second insured. And there's a reason for that, which is wonderful, actually, in terms of the cost to you. But just remember, if you are going to provide for your surviving spouse, second to die life insurance is not what you're looking for. You are looking for just simple life insurance, whole life insurance, term life, probably not term, but you just want a insurance based on you as the insured. You die, it pays out. Second to die life insurance, you die, it doesn't pay out. And I'm saying you as me here because I'm going to be the first to go. It only pays out when Charlotte dies. Now, it could pay out to my kids. It could pay out to the church. It could pay out to a myriad bunch of things you want to pay out, and it will pay out upon her death. All right, so that's the way it works. Now, we are not putting this in a trust, all right, just as an FYI. You don't need some fancy trust for this. It's just we own it. It will be included in her estate, not my estate. It'll be included in Charlotte's estate when she dies because she owns the policy. I die, she is still the owner, she's still the insured, and just like any life insurance policy, at her death, it is in her name as part of the overall taxable estate. All right, we're not talking a trust. We don't need that. All right. Now, at some point, maybe you do if the estate tax drops to where it was in 2003 at $675,000. But we're so far removed from that right now. Do not think that second to die life insurance, you need a trust. You just simply do not. All right. So at the end of the day, Charlotte survives me. It doesn't pay out. She still has to keep paying the premium. So we got to make sure she has a cash flow to afford that as well. And that's the second consideration. Not only does she not get the insurance when I die, but the premiums are still going to need to be paid for as well. All right. So because of that, there are two constraints that when it comes to life insurance to create an estate that you got to consider when it comes to second to die. Now, with that said, the benefit of second to die life insurance is it's just cheaper because they're insuring two lives. And you can look at any Vanguard's got a wonderful tool. I have it on here someplace. But anyway, they show you that the likelihood of me surviving, the likelihood of Charlotte surviving, they'll say 25 for me, 30 for her. But for both of us combined, or one of us combined, is 45. If that makes any sense. So 75% chance I'll die before I'm 85. 65% chance Charlotte will die before she's 95 or 85. There's a 30% chance one of us will die before we're 90, if that makes sense. So basically, when you combine the two life expectancies, it's almost like when you live together. When you've taken your household and your wife's household, or my household, my wife's household, or whatever, your spouse's household, $1,000 for you, $1,000 for her, you combine them, you're only spending $1,500. That's kind of the same way life insurance, second eye life insurance works. It costs $1,000 for me, $1,000 for her, but combined it only costs $1,500. because it only pays out at the death of the surviving spouse. And it doesn't have to be marriage, by the way. It could be you and your brother. It doesn't matter. It only pays out the death of the surviving spouse. So what happens in this case, because insurance companies say these guys as a unit are going to be around longer than they would be individually, we can charge them less up front for two reasons. We're going to have less, it's going to be more time for them to pay premium, and because they're going to be paying premium for these many, many, many years to come, which means they're not likely, the insurance company, to suffer a significant risk of a major issue happening where they got to pay a premium very quickly. And by the way, if I get a heart attack and die, they don't pay out. So I might be gone, but it's based on the mortality tables of two people as opposed to just one. I know it's kind of confusing, but just remember, when you're taking two people, their life expectancy is actually longer than would be 1 + 1. It's just interesting because I don't know why maybe they're happier. I don't know why, but that's just the way the mortality tables work. That a husband and wife, and just using that example today, will actually live longer actuarially than an individual woman or an individual man. So because that, the insurance companies don't have to pay out for that much longer, and they're going to get more premiums for that much longer as well. So that's the thing about second to die. Now, the reason I like it, because it's cheap relative to individual policies. Because remember, an individual policy, more likely I'm going to die, more likely the insurance company is going to pay, and more likely they're going to pay it quicker, which means they have to have more cash on hand to pay those claims. So because of that, they got to charge a higher premium, just more risk to the insurance company. Can't blame them. But for second to die, because that's not as likely to happen anytime sooner, as soon they can charge a lower premium, because it doesn't matter if I die. It literally doesn't. It only matters if Charlotte dies, essentially, because she is the person that's going to survive me, if that makes sense. So you can also be underwritten for a second to die life insurance policy, even if in this case, me, isn't that great shape. If you've got diabetes or something like that, you can still qualify for a pretty good policy as long as the surviving spouse, whoever that's going to be, the most likely person, is in pretty good shape, even if the person first to die isn't in a great shape. And the reason for that is simple. We're not going to pay out when that guy dies. It just doesn't matter. I mean, literally, you get hit by a proverbial bus, we don't care because we're covering for both of you guys. Does that kind of make sense? So it's pretty interesting there why I like second to die. So what we did is we have a second die life insurance policy. And basically what happens is it's important to me to leave money to the church, because as much as I try to tithe, I haven't been able to do it to the extent that I like to, just because we have 4 kids, we got some debt. And again, the reason for having debt is the enemy of charitable giving as well, because if you got debt to pay, you're just going to be less inclined to give. There's just no other way around that. So if you want to be a giver, don't take on debt. All right, well, I'll save that for another episode. But anyway, so second to die life insurance, because I haven't been nearly as, what's the word I'm looking for, as I don't know, I just haven't given as much to the church as I'd like to. I just haven't. And because of that, I do feel somewhat guilty by that. But I also say, well, we can do that in a different way, which is we can pay for a policy that will make sure the church gets a certain amount of money when she and I both die. And as long as we keep the policy in force. And so for us, we actually did it on a whole life chassis, essentially. That's going to be the mechanics of it. It's a whole life insurance where we pay the premium, is guaranteed to be there for our whole life. Now, a lot of people use a universal life for a second to die, and I'm not as comfortable with that. As long as there's a guaranteed death benefit in there, I'm okay with that. But if there's no G for a guarantee, a lot of times, again, those universal life insurances don't pay out. So and you don't want a term for universal for a second to die life insurance. That wouldn't make sense, because a term you're going to survive the term policy. It just is not going to work unless there's I guess you could have a term. I don't even know if they do. I guess they do terms for second to die. I don't know. The issue is your term. You don't want a term because you're going to survive the term. The whole point about second to die life insurance is for it to be there when you die for your whole life, which is why we do whole life, because we want it there for our whole life. Exactly. So for us, we say, okay, we're going to pay $250 a month for a $250,000 death benefit. So every month we're putting $250 a month. And if that's not exact sure if that's our numbers or not. So 250 times 12, we're putting $3,000 a year. So now if we do that for 3,000 for 20 years, 3,000 times 20, we'll put in $60,000. If we do that for 40 years, 3,000 times 40, we'll do it for we'll have put $120,000 in there. So I'm 48 now. We've been doing it for 6 years. So if we did it for 4 years, I'll be 80. I'd be 82, 42. I'd be 82 years old when we had only put in 120,000 at that point. So essentially, we'd have doubled the amount of money that's in there as if we both die when I'm 82 and she'd be 78 at that point. So we do it for 40 years or we do it for 50 years, which is kind of my anticipation. 50 times 3, which means we put $150,000 in there, never to change. And with the whole life insurance is that we know for a fact, as long as we make our end of the bargain, we put that $3,000 in there, then $250,000 at a minimum will pay out to the church or whoever we name as beneficiaries. We can always change the beneficiaries. That's another nice thing about it. So we leave it to the church, and frankly, in this case, we'll probably leave it to the kids. And there's a reason for that for other estate planning options where, you want the kids to get the life insurance, you want your church to get the IRA. We'll talk about that in a different episode as well. But let's just say for 50 years, we did when I was 42, I'm 92, I'm dead. Charlotte will be 88 at that point. She's probably dead. I mean, who knows? But at the end of the day, we put 150 in, we get $250,000 to XYZ as beneficiary of the church, tax-free. With whole life, though, what happens is if you have a dividend paying, you're going to get more in that because they have these dividends they accumulate. So you're going to get these paid up amount. I can't remember what it's called. Paid up, PUP, pay up premiums, pay up. There's a thing when it happens every year if you do it through a certain dividend paying group, a participating unit, which is what you want, they'll actually pay more of life insurance. So right now it's $250, but by then, I don't know, who knows, it might be $450 or something like that. Simply paid up additions. That's what it's called. PUA, paid up additions. So as you put more and more cash in there, they're taking some of that cash and using some of the dividends you're receiving, and they're putting that to more paid up additions. So what you're getting is a $250 guarantee. There is a paid up addition that will add to your death benefit each and every year. And that's paid up additions, which is an absolutely wonderful thing about whole life insurance. And I wish more firms offer that. But paid up additions is a big, big deal because what happens is after 50 years, I put $3,000 a year in there. I only have $250,000 as a death benefit. That doesn't look so good. But after 50 years, I pay $3,000 a year for my premium. With my paid up additions, I have a significant amount more because of the paid up additions, and it's all tax free, by the way. So that's what's wonderful. But that's just what we do. There are many different ways to skin this cat. But again, you don't want term life insurance, but you definitely want a permanent life insurance for survivorship life. All right. So what happens is we both die tomorrow. All right. So we put in $40,000 in there. Let's just say, for example, well, we've had it for 6 years. We put in $18,000. All right. So we put in for $18,000. We both die tomorrow. The church gets $250,000 tax free. And again, for the church, getting anything's tax free, but life insurance tax free. You can't beat that from an investment perspective at all. If we die 50 years from now and we put in, $3,000 a year, bear with me just a second. So say we put $3,000 a year as our payment. We got nothing there now. We get $450,000 as a future value, and we did it for 50 years. Our interest rate, 450,000. Bear with me just 1 second, my friends. $450,000 is the future value. We got to do plus minus. There we go. Our interest rate would be 3.95%. That's not bad. And again, that's tax free. So we left it to the kids. That's 3.95, 4% roughly, tax free. What does that equal to? Roughly a long bond. Absolutely. So the whole life is bonds. That's what there is for sure. But so for us now, we say, okay, so we have that part resolved. We can be more aggressive on our stock portfolio because we do have our heirs, be it my kids or the church, taken care of in some capacity. However you want to do it, I don't care. But it's a wonderful, wonderful mechanism to allow you to say, we want to leave something to somebody. We want it to be there. We don't want it to lose value. And we are comfortable enough with paying $200 or $250 a month as a premium to ensure that XYZ beneficiary gets that money at a minimum, the death benefit of what we agreed upon with the life insurance component. Now you can see over here, though, we want to be a lot more aggressive. We want to swing for triples and home runs. So we're going to go into VWO, the emerging markets, fund ETF over Vanguard, whatever, because that will fluctuate up and down. And most likely in the long run, that will outperform a long bond as my life insurance. But see, it's like a hedge. You have a growth growth, but the growth is going up and down. And then you got slow but steady life insurance. They're kind of both combining. But at the end of the day, it's a wonderful option for setting up an estate and leaving money to your heirs. So ideally, what would happen is you say, we're going to leave the life insurance to the kids because the kids would get it tax-free. If the VWO, the aggressive stuff, was in a tax-deferred account, we want to leave that to the church because then that would be tax-free as well. So instead of having the kids get the IRA and the church getting the life insurance, don't do that because the church is tax-free anyway. Now the kids got to pay tax on the IRA. You'd want to change the beneficiary designations to make sure the appropriate persons receive the money in the most tax-efficient way. Or some people say, well, I have, I'm going to do in a brokerage account, my VWO, and that sucker's just going to grow. And again, in that case, it doesn't really matter because what's going to happen is when your kids inherit it under tax laws of today, the VWO, whatever it grew to, they'll inherit tax-free as well because of step up in basis. So it's the IRA that you really want to work around when it comes to estate planning, or 401k or 403b or TSP, because the deferred assets in there are all taxed to somebody other than a charity. So if you're charity inclined and you really want to leave an estate to your children as well, buying a second to die life insurance policy to leave to the kids and then naming your beneficiary as your church or the Boy Scout, I don't care, whoever your boys club, whatever you want to do, is a pretty wonderful thing. All right, so let me just show you some more numbers here. So I looked at this website, survivorshiplife.com. Not familiar with them at all. They'll give you information, then you'll send info for a quote, and then they sell that quote to whatever company they're using. And I don't have a problem with that. I mean, it's fine. Estate tax. So survivorship is the cheapest way to pay estate tax. Survivorship life insurance is the cheapest way to pay estate tax. It really is because it's tax-free. It pays out immediately at the death of the insured. Right now, the estate tax from the feds is not an issue, but certainly from various states it is. And life insurance is wonderful. You just got to understand, if you own it, it's in your estate. So if you're in Massachusetts and you own a $2 million survivorship life insurance policy, you are immediately paid an estate tax on that life insurance. Right? So it is a way to pay estate tax, but it also is increasing your estate taxes too, as well. Medical impairments, as we talked about, prostate, diabetes, high blood pressure, heart disease, cancer are okay because they're looking at the second person, not the first person. The first person, if he has all these ailments, he's going to die anyway. And so the wife is who they're looking at most likely. And as long as she's in pretty good shape, you can still get the policy for sure. It might not be the best premium you can get because at the end of the day, if she dies first, then he's going to die a lot sooner than the insurance company's hoping or anticipating. But without question, if you have these things, you can still apply and still be successful. If during the first year, decide, okay, so they just get 100% of the pay premium. That's fine. All right, so here we go. We got these are non-smokers. Again, life insurance is critical for non-smokers for sure. That's what we want. So I'm going to use let's use a 65-year-old couple. They got 65 and 65, guaranteed level of premium of $10,000 a year, okay? Or you can pay a lump sum of $165. Now, see, I like this a lot. Because here, what happens is I'll tell you what. Let's take a look. So, $10,000 a year or $165 up front. $10,000 divided by 165 divided by 10,000 will be 16.5 years. So essentially, here 16.5 years is if we survive 16.5 years. So essentially, we'll survive until we're 82. We wish we would have done a lump sum for sure, simply because we're still paying $10,000 a year, while this one's paid, what's called paid up. I'm a huge fan of paid up, huge fan of it. Now, I do want to point out best class premiums. All right, so this is the best class, preferred ultra, what we used to call it USA. I don't know, Superman ratings. I don't know what other people call it, but so essentially, you're saying I got to pay $165 guaranteed to have $1 million go to my heirs, whoever that would be. And the nice thing is, you can actually run a simple calculation to see what your rate of return would be. So $1 million is your death benefit. That's our future value. 165 is your payment, no present value. If we 10 years, and if we died in 10 years, we'd have 11.79% internal rate of return. 165 at 11.79% grows to $1 million after 10 years. Which is pretty neat. And that's not even including the fact that's tax-free, by the way. If that's an IRA, you'd have to reduce the taxes from there to get a competitive thing. So if an IRA would be, 14%, you need to get to have the same thing. All right, so now let's say it's 20 years. We're going to say 20 years. You'd get 20, there we go. your rate of return. I screwed that up. Bear with me just a sec. What am I doing? I screwed up. All right, hold on just a second. Let me get out of here. All right, so it's 20 years. We got $1 million is our future value. We have 165,000 is our payment. Oops, 165. Bear with me just a second, my friends. Zero payment. We got 20 years. What's our 9.42? So after 20 years, you're 165,000. Oops, zero payment. Just 9.42. Yeah. So after 20 years, your $165,000 is growing to $1 million. That's what your heirs would get tax free, and that's 9.42 is your rate of return. So now let's go to 30 years, and it's 6.19. So I mean, you can't beat that, and that's guaranteed as long as the insurance company stays solvent. You're getting 6.19. Let's just say 6.2 tax free. So if you're in a taxable bracket of 25%, minus 2.5, you need to get times 1.2. You need to get 7.44 just to match this right here if you're in a 20% tax bracket. That's pretty stellar, in my opinion, if what we're trying to do is solve for estate planning, leaving money to an heir, leaving money to a kid. I love second and die life insurance. I think it's that and the Roth IRA, the two most underutilized things there are. And remember, it's tax free, and you just dump that sucker in, and you're golden. I mean, you don't have to worry about it again. So, guaranteed by $1 billion, highest rated insurance companies, best class premiums based on current assumptions to age 100. Some of these, what happens with some of these policies, and I don't like that, but I don't think they do it that much anymore. But once you hit 100, they'll pay you out whatever cash value is in there. I'm not a big fan of that. So we'd want to make sure that that does not happen. So when you're dealing with a life insurance component company, you want to say, hey, what happens if I live beyond your assumptions at 100? USA would make the assumptions to 120 because they were coming up where people were living to 95, which is what we used to use. Or they used to use, and then they'd have to pay out a check that was taxable as ordinary income. Ooh, bad. Anyway, so that's a thing on second to die life insurance. I don't know who's got Jerry Orifice is his name. Okay, I hate to laugh at a guy's name. My name's Scanlon. So people say, Scandal, you're scandalous with my money, are you? And that's I got to chuckle at that. So I hate that laugh. I just find it interesting. People's different names. But I think you should look at, if estate planning is on your mind, you should look at life insurance, a second to die life insurance, and particularly in the carriers that provide. And if you want to talk about it, by all means, just leave comments down there. Email me at josh@heritagewealthplanning.com. I love talking about second to die. I think it's just a wonderful way for just middle-class people to establish an estate for giving money to the church, or at least making sure that they're dealing with the tax consequences that are built up in your 401k. Hope this helps. If you like the content, as always, don't forget to subscribe down below, my friends. Once you subscribe, hit the bell to be notified for future content, because we do a ton of content here at Heritage Wealth Planning YouTube channel. The blog is heritagewealthplanning.com, heritagewealthplanning.com. And thumbs up and comments are always helpful. And if you like it too, share the video. For heaven's sake, share with people you know. I tell you, that helps me as well with YouTube's algorithm overseers to see who is enjoying the content and whether or not they should provide it to other people. So share the video, and we'll see you next time. Thanks, guys.